afternoon, everyone. My name is Barbara. I am a PhD candidate. I am pleased and honored to present at this conference. My research topic is motivation for business structure choice for Australian small and medium enterprises. I'm very grateful to have such an excellent supervision team, Professor Brett Fredenberg, Dr. John Menes, and Dr. Craig Cameron. I will briefly outline the literature review, the research questions, the methodology. However, I will focus on the result obtained from the case study interviews for stage 2. Then I will articulate some recommendations based on the issue identified from the analysis. This research is based on Skolden's and Folson's theory, which suggests that the structure choice is a trade-off between tax and non-tax costs, with firms are likely to choose a business structure that minimizes such costs. Asset protection was the most important consideration for the choice of business structure in Thread and Fredenberg's study. However, tax factors features in the top 10 consideration. The blue shaded area in Thread and Fredenberg result represent the top most important consideration. However, in the Fredenberg result, the blue shaded area represent the common factors. The green shaded area represent the factors that were identified in Thread and Fredenberg study but were not in the top 10 factors. The orange area represents the factors that were not identified in Thread and Fredenberg study. Our first research question is, what are the reasons for the Australian small and medium enterprises for the adoption of business structures? What are the implications derived from the adoption of discretionary trust by Australian SMEs compared to other business structure? This research consists of 2 stages. Stage 1 involved interviewing 10 SMEs advisors. The purpose of this stage was to develop the 6 vignette or scenario for the case study in stage 2. Stage 2 was a case study approach involved interviewing 48 SMEs from across Australia, as well as a survey. Each of the 48 advisors were given one of the 12 scenarios prior to the interviews. For the new business scenario, advisors were asked what is the ideal business structure that they would recommend for the client in the scenario and why. For the established business scenario, participants were asked if they would recommend a different business structure than the one in the scenario and why. Then thematic analysis was conducted, which revealed 13 themes. The themes were identified by prior literature and analysis for the data from the interview. A unique finding was that all participants except one recommended a combination of structures in which discretionary trust was within this combination, either as a trading entity or as a shareholder of a trading entity. None of the advisors recommended a sole trader or a partnership. The 62.5% of advisors recommended this structure, a trading company to operate the business with the share owned by a discretionary trust with a corporate trustee. 21% recommended this structure, a discretionary trust to operate the business with a corporate trustee. However, 14.5% recommended this structure, which was mainly recommended for scenario 4, which is a medium-sized business. That's what advisors call a Rolls-Royce of a structure. A separate company to operate their business, a separate company to hold their patent, a separate company to hire employees. Those 3 companies are then owned by a holding company, which is then owned by 100% of the share are owned by discretionary trust. Summary of factors. The red shaded areas represent the strong factors, which is 100 from 100% to 75% that were referred to by participants. The orange shaded areas represent the medium factors, which are 75% to 50%, and the yellow shaded areas show the least mentioned factors, less than 50%. As we see for the scenario 1, which is macro business, for the established scenario, participant recommended trading company with a discretionary trust, whereas for the new scenario, participant recommended a discretionary trust with a corporate trustee. The case was similar for the scenario 2, which is macro business as well. And in the established scenarios, a trading company with a discretionary trust, that's the structure was recommended, whereas for the new business, a trading discretionary trust with a corporate trustee. Whereas for the scenario 3 is macro business as well. There were clear preference for a trading company with a discretionary trust. The tax consolidated group was recommended for scenario 4, as I said previously, which is a medium-sized business. However, there is more clear preference for the scenario 5. In scenario 5, among advisors in recommending a trading company with a discretionary trust for both the established and the new scenarios. So there is a bit of preference as well for the trading company with a discretionary trust for scenario 6, which is small businesses. Tax minimization or tax rate was strong factors, which was referred by 94 of the participants. The emphasis on recommending a company as a trading entity owned by a discretionary trust was a twofold focus, being the effectiveness of taxing business income at a low corporate tax rate, combined with the benefit of streaming of franked credit through the discretionary trust to family members, as well as being able to income split. This demonstrates the multifaceted of the nature of the influence of the tax rate on the choice of business structures. On the other hand, in the new scenario 1 and 2, the advisor primary focus was toward the use of trading discretionary trust to obtain a tax benefit through income splitting, distribution of income to family members with no income. Advisors' primary focus was on isolating at-risk people from asset-holding people by having a discretionary trust to hold the shares of the trading company rather than being held by individual. Some of the common techniques used by advisors to achieve greater asset protection were having a corporate trustee rather than individual trustee for the trading trust to minimize the exposure of individual to risk, and holding as well the available asset in a separate entity from the trading entity to quarantine against potential risk of operating the business. These findings highlight that business owners using trust may benefit from asset protections while having the freedom of not being under regulatory restrictions that apply to corporations. However, from a family law perspective, a business structure may not impact on the outcome of divorce in the terms of marital asset. So having a discretionary trust, a business owner can access the 50% capital gain CTG discount on the sale of the business or on CGT discount on the sale of the asset of the business. However, having a company, under a company, there's no access to CGT discount on the sale of the business or on the sale of the asset. However, if having a company with a discretionary trust as a shareholder, might provide access to 50% CGT discount on the sales of the shares. Having succession planning or exiting the business, having a trust might give access to CGT discount on the sale of the business. However, a company doesn't give access to the CGT discount on the sale of the business. However, under the trust, you cannot sell a business. You can only sell the asset of the business. However, under a company, you can sell the business out of the company. Under a trust, a tax-free transfer of control of the business by simply for the trustee to step down as a trustee. Under a company, transfer of share might trigger CGT event. A trust might have a limited life of 80 years. It's not an ideal structure for intergeneration business. It might work for one generation or two. It would pose a great issue for the third generation. A company has an infinite life, yet if by having a trading company with a discretionary trust, you can sell the business or part of the business by selling the share to a third party. Company ability to retain profit. A company has the ability to retain the profit kept at profit at low company tax rate. Therefore, reinvest in the profit. A company pay less tax. It's 25% tax rate, and is coming to 25% for the small entity. And then, therefore, they invest more in the business. Trust has to distribute the profit to beneficiary or to corporate beneficiary. Otherwise, the profit not distributed is taxed at the highest marginal tax rate, and therefore, so they cannot reinvest the profit back in the business. And if they want to reinvest that profit, they issue with Division 7A. For example, you try with a discretionary trust, operating a business, discretionary trust, distribute income to beneficiary A and then to beneficiary B and then to a corporate beneficiary or a bucket company. Then if this fund has to be reinvested in a discretionary trust, this might create an issue with Division 7A. The Division 7A might apply to such fund and consider it as unpaid present entitlement, which is taxed at 45% tax rate plus Medicare levy. When participant advisors were asked about the disadvantages of the recommended structure, the common view was adopting multiple structure in one entity could increase complexity and compliance and administrative cost. Company were identified as easily understood, and understanding the trust can be difficult for taxpayers. Therefore, they require professional advice. And when participants were asked if there is any inhibitors from implementing the recommended structures, a common view was for the established scenario was transfer cost, capital gain tax, and stamp duty costs depends on the state. For restructuring an established business, some advisors identifies that the application of certain restructural relief is uncertain and the inhibits additional administrative cost as well. However, advisors mentioned that over time trend in structure that decrease in the corporate tax rate and plus an increase in complexity of trust has created a shift from trust to a corporate, a shift from a trading trust with a corporate trustee toward trading company with a discretionary trust as a shareholder. This comment is by one of the participants. The result of the survey, the weighted average factors for company and trust was limited liability. The top factor factors, retaining income at lower tax rate, control for owner. However, such a structure is not good for tax compliance costs. The result for the survey as well for trust with the corporate trustee structure shows that in the top factors were the income splitting, flexibility in distribution, flow through of tax concessions, small business CGT concession, and CGT discount as well. However, access to and development and research and development concession is not ideal in this structure. Weight average for consolidated group. Tax group was identified some of the top factors were control for owners, business expansion in Australia, access to research and development. However, this structure is not good for tax compliance costs, increased tax. What if no changes to the policy? Adopting multiple entity for one business exasperate complexity on compliance costs. SMEs are adopting multiple structure for a single business entity to benefit from the flow-through advantages available through trust but not through a company, and the ability to retain income and keep it at a low tax rate in a corporate beneficiary. Such a practice in adopting legal structure could lead to incurring additional costs with little to no economic benefit. Given that this research is based on Scholes and Watson theory, whereby businesses are more likely to select a structure that minimizes the tax costs, it's evident from the case study that tax was the most dominant factor considered by advisors. For example, the apparent focus of the recommended discretionary trust within a combination of structures was partly to benefit from income splitting, flexibility in distribution, and the flow-through of capital gain and frank dividend to the beneficiaries. Some of these advantages are not available in other alternative structure. For instance, a sole trader or a wage earner cannot split their income with their family members. It's clear then that the current Australian tax system operates in a non-neutral way. As breach of tax neutrality, one of the important elements of the tax system can occur by the influence of the differences in a tax treatment that exist between different business structures on the choice of the business legal structure by owners. This can be explained further by the loss of tax revenue of at least 1.2 billion to government each year by using discretionary trust to minimize tax by allocating income to group members. So it's common when commencing a business to start as a sole proprietor or as a partnership. However, when the business grows bigger and need to hire employees, limited liability then becomes of a concern. For this reason, business owners might restructure to a company with share owned by the discretionary trust, which is an ideal and a common combination of structure. Restructuring a business involved a valuable asset can be an issue because of the transfer cost of capital gain tax and stamp duty. The small business restructure rollover relief subdivision 328G does not apply to such a structure. This may result in adopting incorrect business structure whereby the business is vulnerable being exposed to risk. As one of the advisors put it, most of the time it's not about the tax, it's about the asset protection, because if you got sued and you end up with nothing, you've got no tax to pay. Recommendation. A clear message which emerged from the analysis was to set up the structure correctly from the beginning to avoid the cost and complexity of changing the structure in the future. For this reason, the Australian government may consider some incentives such as a tax offset to lower the cost of advice. For the tax system, may consider similar tax treatment across different business structure. This may achieve a greater tax neutrality. Another recommendation, to allow trust to accumulate profit. This may assist businesses to develop internal capital necessary for business development and may lessen the complexity and compliance costs for this sector. The last recommendation is taxing the family as a unit of taxation, such as the current jurisdiction in France. This might provide a greater fairness in the taxation system. This might offer as well a greater equality in the tax treatment amongst wage earners, sole traders, partnership, trusts, corporate and non-corporate SMEs businesses. This might also tackle the issue of poverty. Thank you for listening to my presentation. Happy to take questions and feedback later on.